If you're a first-time home buyer wondering how much you need to buy a home or which loan gives you the best chance of getting approved, then this episode is for you. We're going to be talking about FHA, conventional 3%, USDA, as well as VA. Now, these programs all sound very similar, but the wrong choice can cost you thousands in extra payments. Today, we're breaking down exactly how each one works, the down payment rules, the debt to income limits, the credit requirements, and giving you a simple way to know which loan truly fits your situation. So make sure you stick around because by the end of this episode, you'll know exactly which minimum down loan helps you qualify today and put you in the best long-term financial position. So with that, Josh, let's start with the loan program that most first-time home buyers look at when they're trying to buy a home.
Absolutely. FHA it's funny. Everyone that I talk to, first-time buyer-wise, they almost always start with, hey, I want an FHA loan, or the exact opposite. Do not talk to me about an FHA loan. They're terrible. They're evil. And neither one of them are true. That's probably going to be the biggest takeaway for you guys today of listening and hearing this. It's a great program. I love FHA loans, but it's not right for everyone. And it is right for some people who may think that it is not. So let's start with the one that if you're watching this on YouTube, you've probably seen a YouTube video that every YouTube mortgage person leads with their FHA video, 3.5% down, 580 credit score. That is true. That is the guideline as written, 3.5% down, all the way down to a 580 credit score. You can actually go down to a 500 credit score, Jeb, but below 580 needs to be 10% down. Let's talk about kind of an important distinction there with those credit scores. If you get below 620 and really below 640, there's a very good chance that you're not going to get an automated approval. It's not guaranteed. It looks at all of the factors holistically. So I had a buyer here that was putting like 15% down, had a 602 credit score, and we got an automated approval because of the bigger down payment.
All right, if you can give me 30 seconds of your time. First, we want to say thank you. Honestly, the fact that you guys keep tuning in every week, it means the world to us. When we started this show, it was just two guys talking real estate and mortgage stuff, and we had no idea it would grow into this. The truth is, we never dreamed of being here, and yet here we are. And that's all because of you. Secondly, we're not done, not even close. We feel like we're only just getting started. So if you enjoy what we're doing, do us a favor, hit that follow button. Believe it or not, only about 30% of folks who listen regularly actually follow, and that simple click really helps us keep things moving forward. Here's our promise to you. We're going to stay on top of the information that impacts you. We're going to keep asking the questions that you want answered, and we're going to keep making this show as good as we possibly can now and into the future. So thank you again. We appreciate you being here, and we're excited for what's ahead.
But let me stop you real quick. Why does an automated approval even matter? Why does the borrower care if they're getting automated or not?
If you don't have the automated approval, you're going to be restricted to lower debt to income ratios, which vary by your credit score, the whole big picture. So lower debt to income ratio, and you're generally going to have to meet compensating factors, which some of them are simple. If there's household income that can't be used for qualifying, but will be used to offset the payment, having some reserves, some of those things can be used to offset. But the big picture is manual underwriting is a little bit harder. But more importantly, if you have that lower credit score, you can go all the way down to a 640, really a 620, and still get good terms with an FHA. Once you go below 620, many lenders we're out of the game. We're not going to do them. And the ones that do generally get a premium for it in terms of the interest rate. So you have less options, higher interest rates, more restrictive debt to income ratio. In a perfect world, we would love to get you to 640, but 580 is the limit for 3.5% down, 500 for 10% down. So those are true and real. But if you look at the numbers, it's way less than 10% of FHA loans are done to sub 600 credit scores. It's probably more like 4 or 5%. So just know that it gets harder, and many people just don't do it. And realistically, most people with a 585, 590 credit score, they want to start by boosting their credit score, right? They know, hey, I want to buy a home, but I got to get my ducks in a row. So that piece is important. A piece that used to be something that would drive people to FHA, but is now kind of been modernized within conventional loans, Fannie Mae and Freddie Mac loans, is FHA has always allowed 100% of the funds in the transaction to be a gift. So a lot of first-time home buyers, you're buying a $300,000 house, you need $10,500 down. Mom and dad say, here's $15,000, go buy the house. And that's always been acceptable FHA. We can say when we get to the conventional section, that is also now acceptable conventional. There used to be restrictions and requirements around that. But either way, we can get that all from a gift. So probably the number one thing that drives a lot of first-time buyers, especially in this era of low affordability towards FHA, is it has the biggest debt to income ratio. Now, they do it a little bit differently than conventional. We have a 47% housing to income ratio. So everything that goes into your housing payment, principal and interest, taxes, insurance, if there's an HOA, anything included in your monthly payment has to amount to 47% or less of your total qualifying income. Then they have a secondary ratio there of 57%. So you can go, once you add in all your other debts, student loans, auto loans, credit cards, anything else that shows up on your credit report, that plus your housing payment can go to 57%. So if you have a lot of debt, it's going to limit. You're not going to be able to go to 47%. If you have no debt, you're still going to be capped at 47%. You're not going to be able to go higher. But that flexibility is probably the biggest benefit there of FHA. Something, we're going to talk about 4 loan programs today, Jeb. FHA, USDA, and VA. Those are true government guarantees. So prior to 2008, the mortgage markets looked at all of those loans and said, hey, those have higher default rates because they have lower down payments, first-time buyers than conventional loans. So we want, if we're going to buy those mortgage bonds, we want a higher yield. We want a higher interest rate. Post 2008, the market stepped back and said, hey, conventional loans have an implied government guarantee. These are literally guaranteed by the government. So we're going to get paid one way or the other. Borrower pays us or the government pays us. So post 2008, FHA, USDA, and VA have lower interest rates than conventional loans, especially at these lower credit scores. So if you're like sub 700, sub 680, you'll see a fairly big difference between an FHA rate and a conventional rate. And you're going to see the same with USDA and VA when we get there.
Got it. So nobody ever complains about the minimal down payment or allowing the lower credit scores. Where the complaints come in about FHA for most people from the outside looking in and going, it's a bad loan program, you shouldn't do it. It really comes around the mortgage insurance, and we need to talk about that, as well as the appraisal. And I think the appraisal is one that's misunderstood, really misunderstood, because it gets a really bad rap for something that's not really that bad. I mean, the issues that are pointed out in there are typically pretty easy to address. And if they're not easy to address, then it's a bigger problem than you probably want to take on as a first-time home buyer to begin with, at least using your basic FHA loan. So with that said, Josh, what are the actual requirements when it comes to an appraisal with FHA?
So the biggest picture, so the biggest thing that you're looking at is the house has to be safe, sound, structurally secure, sanitary. Like if it's full of rodent infestation, it's not sanitary, it's not safe. Those are the big things they're looking for. The biggest difference between a conventional loan and an FHA is FHA 10, 12, 15 years ago wrote into their guidelines that the appraiser has to do a visual inspection of the home. So what are they doing? They're turning on the heat source. They're turning on the range. They're poking their head up into the attic. They're looking around for a few things that a conventional appraiser doesn't have to look for.
But
does
that
mean
not
that
an inspector?
They're not an inspector. It is not an inspection. Never replaces the inspection that your realtor is going to hook you up with an inspector and have done. So you want to have both, but they are doing, if you chose not to, their job is to make sure anything obvious and major that you as a home buyer, first-time home buyer might miss, that trained appraiser is not going to miss. For the most part, it's never an issue. You and I have done a lot of FHA deals together, and a couple times we get some chipping paint. We had some electrical lines that hung too low in the backyard. Basically, health and safety issues, things that you as a buyer would want.
Because I think that provides some context to those listening. We had one we did a couple of years ago, and 2 things showed up on the FHA appraisal that essentially needed to be addressed, if you will. So the deal isn't dead just because the appraiser finds these things. It goes back and it says, hey, Josh, or Josh comes to me and says, hey, Jeb, this came up in the appraisal. If we want to get this loan through, we've got to essentially get the seller to cooperate with us. We need them to fix the items in this report because they're essentially health and safety items. And if we get them addressed and the appraiser goes back out and inspects them, we're good to go. And in the case of this property, one was peeling paint. There was stairs outside that had been painted. It was concrete that had been painted over time. And the paint was chipping, and that was called out. And then in the backyard, the people hadn't essentially taken care of the yard because I believe the house was a flip, if I remember correctly. And then when they flipped the property, they just stuck to the inside of the property. The backyard, basically the bushes had overgrown is what happened. And it was up into the point where it was into I don't even know if it was the power lines or coaxial or whatever it was, but there were lines hanging down into the trees. And we went back and the seller basically cut down the tree in the backyard. I mean, that's how they solved the problem. They just whacked the damn tree off. And then secondly, they repainted the stairs and problem solved, right? Easy deal, didn't kill the deal, but it was something that did come up.
And think about some of the other things that can come up. That's a great example, real world example. But let's say you have a tripping hazard. Let's say the walkway up to the front of the house is buckled and someone could trip. And the appraiser is going to see that and they're going to say, we can't have that. Let's say there's 4 steps down from the living room to the sunken family room, and there's no rail. Obvious things like that. A lot of times what we'll see is someone has done some crazy wiring. You'll see like a cable hardwired into an outlet, or an outlet that has 14 things coming out of it. Just obvious visual things that you probably caught as a buyer walking through the house, but all generally pretty easily fixable. So from that perspective, the other one that kind of gives people strong feelings about FHA, pro or con, is the mortgage insurance. So the good part, let's talk about the good part, especially if we're in with a sub 680 or below credit score. The monthly mortgage insurance with a 3.5% down FHA is 0.55%. So that's relatively low, especially if you get to that 620, that 580 credit score. If you have a 580 credit score, you're trying to get a conventional loan. If you could get it, that mortgage insurance would be 1.7, 2% annually. So when we look at that, it's a really reasonable amount. But why we also start hearing that, hey, people with higher credit scores shouldn't do this. Someone with a 780 credit score might get a 0.32 mortgage insurance versus that 0.55. So the monthly for lower credit scores is great. For higher credit scores, it's average to not bad. The biggest issue is FHA does a split premium mortgage insurance. You also pay 1.75% upfront. So you don't pay it, you don't write a check for this. You can, but no one does. Maybe 1 in a million, 1 in 1,000 people actually choose to pay it upfront. It gets financed into your loan amount. So you put the 3.5% down, they add 1.75 back on top of that, and that 1.75% goes to the FHA, and it goes into a fund along with the 0.55 monthly that you're paying that goes there. And when someone defaults, there's a fund that is adequate reserves there for the FHA to pay claims so the lender gets made whole. That's why they're willing to make a loan to you at 3.5% down.
Yeah. And what I like to point out with this is it doesn't matter if your credit scores are 700 or 620 or whatever, you're going to have both the upfront mortgage insurance and the monthly mortgage insurance. There's no way around it. You can't get around it. Now, with that said, Josh, I guess the other downside when it comes to mortgage insurance is that, you know, with your typical conventional loan, people have heard that, hey, once you put 20% down or you get 20% equity in the property, that mortgage insurance is going to fall off, or at least you can call and get an appraisal and get it adjusted or what have you. FHA doesn't allow that, right? So currently, FHA with the monthly premium stays on there for the life of the loan, which
unless
sucks.
you put 10% down or do a 15-year term, which no one does. So sure. What you were saying is pretty much 99.99% of all FHA.
But to address the question that most people ask when it comes around this is, can I refinance at some point in the future if I have the equity, get out of an FHA loan into a conventional loan and remove the mortgage insurance? And the easy answer is yes. You can refinance at any point and get out of that FHA loan if you want. Now, if you don't have the 20% equity, the chances are you're still going to have some form of mortgage insurance with that, whatever type of loan you do. But when you're with FHA, it's on there for the life of the loan. It's just the cost of doing business is what I tell people. If you have the 20% down or you want to wait until you get the 20% down to avoid it, by all means do that. But most people don't have that option. So the option is, hey, if I want to buy a house now, then the mortgage insurance is part of the game and I'm willing to do it. And Josh, we've had several clients over the years that have gone in that option, been able to refinance and get rid of it and done very, very well. And had they waited, we don't know what would happen.
And the thing to remember is before it was permanent, the way that it was written, you were going to have mortgage insurance on your FHA loan for 11 years unless you refinance. It was like 11 and a half years. So most people buy or most people sell or refinance way ahead of that. So it's almost a non-issue. No one cared when it was on there for 11 years, but now we say it's going to be on there for 30 years. People magically think they're going to stay in that loan and in that home for that period of time when they don't. So really, To me, when I'm saying who is the ideal FHA buyer, it's someone who needs flexibility in terms of credit, lower credit score, and wants the lowest payment. Even people with a 720-ish, 740-ish score, the FHA loan, because of the lower interest rate, is going to have a lower monthly payment. So if you're payment focused or you need some flexibility anywhere in debt to income, looking at credit, source of funds, FHA is a more flexible option and a very good option.
All right. So with that, Josh, let's transition to probably the closest loan program that resembles FHA with regard at least to a down payment, and that is conventional 3% down. So now, for a long time, you didn't have this option. Now you do. As a first-time home buyer, you can buy a home, putting 3% down, and go conventional. So there are definitely some benefits to this program, assuming you qualify. But I will say, I mean, from the outside looking in, Josh, more often than not, if you're doing that minimal down payment, you're going to have a higher payment. But let's talk about it, Josh. What are the kind of the basic guidelines of this program, and then we could talk about the pros and cons.
Something really important, which is first-time home buyer. For a 3% down, you have to be a first-time home buyer, or you have to meet the Home Possible or Home Ready guidelines per Fannie and Freddie. And the biggest thing there is you have to be 80% or lower of the area median income. So if you make good money, if you're looking to buy in LA County and an entry-level home is $700,000, you want to put 3% down, you're probably going to be way above 80% of the area median income. So you will need to be a first-time buyer. And the definition for that is, have you taken a mortgage interest deduction in the last 3 years? So most of you listening are going to be fine. That 3% down is going to be an option for you.
And I don't know if we mentioned this, Josh, but it's important to note if we did not, I don't remember 5 minutes ago, sadly. FHA is not only for first-time home buyers. You do not have to be a first-time home buyer to use FHA. So that there's a big distinction there in these two programs in that just alone.
Again, that doesn't matter to our audience. With some minor exceptions, you cannot have 2 FHA loans and some other different things there, but you don't have that first-time buyer requirement. So important to note. So 3% down. 3% down is less than 3.5% down. So generally, by 0.5%. So again, we use that $300,000 example. It's $1,500. It's real money, right? A lot of our first-time buyers are stretched and trying to figure out, where am I coming up with the last nickel? So less, that's better. We used to say conventional loans have a 620 minimum credit score. So we are going to do a future episode in detail on this once we see what this looks like out in the wild. In that, FHFA has issued guidelines for Fannie and Freddie that say, doesn't have to have a 620 credit score, no reference to it, no minimum. Doesn't mean no standard, it means no minimum. It means the automated is going to be looking holistically at everything there. And it's supposed to be looking at rental history, other things. So we don't even want to say you have to have a 620 credit score. What I'm going to say is if you don't have a credit score, you have a sub 620 credit score, the interest rate on the conventional loan and the mortgage insurance is going to be so much more expensive that you're still going to want to go FHA. But we'll do a full episode breaking that down. So where this becomes beneficial is those people with really good credit, because the interest rate differential will be less between FHA and conventional. Maybe you're within 1/4 to 3/8 on interest rate, but you don't have to pay that 1.75% upfront mortgage insurance premium. So you end up, even though you're putting a lower down payment, you end up with a smaller loan. So smaller loan, smaller payment, that offsets it a little bit. The mortgage insurance for people with a 760, 780, 800 credit score, it's a sliding scale on conventional loans. I told you, hey, it doesn't matter what your credit score on FHA, 0.55 with a 3.5% down. On a 3% down, it can be as low as 0.25. It could be as high as 1.95, just depending on where those scores are. So the higher your score is, the more advantageous this option gets. And those people with higher scores generally have less debt. So the debt to income ratio is not going to be quite as important. They don't need the flexibility in terms of looking at credit and payment histories the way we need for FHA. So that's why generally the higher the scores go, the more we want to look at this. Now, in terms of that debt to income ratio, conventional does this differently. They have a single ratio and it's 50%. So all of your debts plus your new mortgage cannot exceed 49.99. Actually, Freddie Mac will let you go to 50.49. They round that down to 50, but just call it 50%. Now, are you guaranteed to get 50%? You are not. That is not the way it's written in the guidelines. And the lower your credit score, the less likely you are to get that automated approval at those higher debt to income ratios. So don't do your internet research. I have a lot of clients that find us through Jeb's videos, through the podcast and the podcast videos. And they say, well, I know from the internet looking at this. It's not possible for someone in a 12-minute YouTube video to give you all of the ifs, ands, or buts about it. So yes, it's 50%, but it is not 50% for everyone. And if you have a lower credit score, you are probably not getting to 50%. I've seen them approve as low as 35%, and anything above 35% breaks it. So from that perspective, this is what your mortgage professional should be doing: guiding, advising, not telling you conventional is better, FHA is better. It's walking you through the pros and cons, gathering all of your information, and letting you know what's possible. Let's assume that you are a borrower who can qualify for either. You have a 700 credit score, you have the money to do 3 or 3.5% down. We should just run the numbers. We go, I have an automated approval conventional. I have an automated approval FHA. Here's the comparison. Here's cash to close. Here's monthly payment. Here's how much you owe at the end of the 3.5% down payment plus the 1.75. The numbers never lie. It is shocking to me how many times I talk to people, oh, I was pre-approved and the loan officer told me I should do this. Not my job to tell you what we should do. It's my job to help you ask and answer the questions that matter the most to you, because there are rational responses. I've had borrowers with 800 credit scores. We run the numbers and the guy goes, FHA is way better. And I'm like, okay, well, and what is your thought process with that? It says, the payment is $220 lower a month. Yes, that upfront mortgage insurance payment is $60 or $6,000, but it's a 30-month break even. So after the end of the 30 months, I come out ahead anyways. And from day one, I have a lower payment, and the lower payment is most important to me. A lot of 800 credit score borrowers will go the other direction. But that's what I'm saying. I can't decide for you. I can help you figure out in your head that decision-making process, what is most important to you.
And that's really what the educated home buyer is, Josh. It's informing buyers where they have enough information to make informed decisions. And that's all we do here, right? Is guide you basically through your options and help you make the right choice. So with that said, if you're out there in the market, you're getting pre-approved, you're trying to get a second quote, whatever it is, use that link in the description of the video, reach out, talk to the team here. We helping a lot of people on this platform, as well as, across other platforms, get through the home buying process. We'd love to help you. So just make sure you check that link there, Josh. So everything with this loan program isn't all rosy, right? There are definitely some downsides, if you will, when compared to FHA. One is, like you said, a higher interest rate, right? Typically going to have a higher interest rate than you are with FHA. Most of the time, especially when you start to get the lower credit scores, Josh, you get probably sub 680, sub 700. FHA is going to look a lot more attractive than conventional, even though, you're putting less money down. So I don't know if you want to dive into any of that stuff, but that's, I think, the biggest differentiating factor between FHA and conventional, and what helps make the decision for most people. It's, hey, I'm coming up with less money monthly, even though I'm a little less in down payment, and I feel comfortable just not putting every dollar I have into my monthly payment or what have you.
Really is no different than any other buyer. It's not a first-time buyer thing. It's not a minimum down buyer thing. Figure out which programs you qualify for. You have enough income, you meet the debt to income guidelines, you meet the credit guidelines, and you have sufficient cash to close. Now we lay them out side by side. What's my monthly payment? What's my total cash to close? How much can I buy? How much do I owe? And generally, the numbers are going to talk to you. The last thing I would like to add in there is, I do hear from a lot of people who've talked to other lenders. And if you've spoken to a mortgage bank, so not a broker, not Chase, Wells, Wells Fargo, those types, but a local mortgage bank, without naming any names, oftentimes they will tell you, oh, FHA rates are a little bit higher, VA rates are a little bit higher, which is absolutely not true. Those lenders oftentimes use their government loans to subsidize more competitive conventional rates. So if someone's running the numbers for you and they're showing you an FHA or a VA or a USDA rate that is the same or higher than conventional, do yourself a favor and make sure you reach out to a broker. Brokers are not always better, but brokers in government loans are almost always going to have better terms available.
All right, good stuff, Josh. So I think that we got kind of the gist of everything there. Again, one thing we didn't mention, we kind of mentioned it earlier, conventional, once you have equity in your property, you're able to get rid of that mortgage insurance by either, falling off naturally once you get to 78%, or you have some, 20% equity in that property. You're able to call the lender. They can do some sort of appraisal, BPO, what have you, and adjust accordingly. So big benefit there. But what I will say is by the time you pay down to 22% on your mortgage, most people have probably refinanced or done something at that point anyway. So it's probably less of a concern, more of a selling feature up front than it is something that most people actually use, especially in today's market. So let's talk about USDA, Josh. It is the least down payment option of the ones that we've talked about, 0%, but probably the hardest to qualify for, just because of the restrictions around income, the restrictions around location, just restriction.
So let's look at the biggest and most important one. It's USDA rural housing. So they have a map, and the map of eligible homes is shrinking year by year. As the population grows and we get further and further out, the number of eligible homes is smaller. Now, if you're in Iowa, probably widely eligible other than in the biggest cities.
Yeah, I think that's important, Josh, because I kind of sold it as, really restrictive. But, when I think it's something like 90% of homes in America can qualify for USDA or something like that. But you don't really think about it because we're in this densely populated market where it doesn't happen here. But when you look at the whole United States, there's a lot of homes that do qualify. Just if you're in a big market, it's.
If you don't have any money to put down and you think USDA is the answer, go to the map and start looking at areas where you're interested, because that's a hard stop. There's no fixing it. There's no making that property USDA eligible if it's not per the map. So that's the first thing, geographic eligibility. Second one, income limits. In broad terms, a 1 to 4 family, 1 to 4 member household is going to be 120,000 or less. It's a little 119 and change, but call it 120, and it goes up to a little over 158,000 if we have 5 or more member family. And this is going to be important because USDA will tell you there is no loan limit. Okay, there is no loan limit, but there's an income limit, and they just reduced their housing to income ratio. So we talked about we have a double ratio with conventional is 50. The housing to income ratio with FHA is 47. These guys were at 34, and you're like, whoa, that's restrictive. Well, they said, hold my beer. We're going to get a lot more restrictive. So just in the last, I think it was the beginning of November of 2024 or 2025 here, they rolled it back to 29%. So it makes it very difficult. If you are in that 1 to 4 member household bucket and you have 120,000 of income, you can't even get to $400,000 in purchase price. So you need to know your area. Again, if you're in Omaha and you can get a nice house for $265,000, you can probably make it happen. If you're somewhere where homes are $475,000, it's probably not going to happen, even if the home is USDA eligible. So those are the big pieces that we want people to look at. Now, let's answer the question, should I do a USDA? The home is eligible. I'm underneath the income limits. I can meet that 29% debt to income ratio. So should I do this? And the answer is almost absolutely. So it is very similar, other than the differences that we just talked about, to an FHA loan in that they do upfront mortgage insurance premium, but instead of 1.75%, it's 1%. Most people hear that and they're like, 1% is not bad. Instead of the 0.55 a month, it's 0.35% on the monthly. So very little in terms of mortgage insurance. It's just much more restrictive guidelines. Another cool and interesting nuance to the USDA loan is, let's say you agree to buy a home for $300,000. Seller says, I'm going to sell you the house for $300,000, but I will not pay a dime of your closing costs. You're like, okay, so I got to come up with all my own closing costs, zero down. I need $10,000 to make this happen. If the appraisal comes in at $310,000, USDA is the only one that will take the higher of the sales price or the appraised value. So you can get a $310,000 loan and cover all your closing costs in your loan. FHA won't do that. Conventional Fannie Freddie won't do that. VA won't do that. I don't really know of any other loan program. Maybe there's one out there. I'm sure there is. But in general, that's the only one that's going to do this. So what I always tell people is, assume you meet the guidelines. You would never do FHA over USDA if you can qualify for both. We would sort of go back to the same offset of, is USDA better than conventional? Well, 0 down versus 3% down. We have a little bit of the same mortgage insurance issues, but it's a much smaller gap. So beauty's in the eye of the beholder. Run the numbers. You take a look at it. For me, I would 99 times out of 100 go USDA over a minimum down conventional, but you need to see the numbers and decide.
All right, Josh, that pretty much sums up USDA. Now let's talk about the best loan program out there, Josh. Probably the most difficult to qualify for, just because you have to be eligible up front before ever looking at income or anything else. Like, it's a program only meant for veterans, Josh, and we're talking about a VA loan. So let's summarize it quickly, just because I know the majority of people listening here are not probably VA eligible. But what are the benefits of VA? Should I go become a veteran in order to get?
I would say over a lifetime, since homeownership is a hard thing, if you are considering different career paths or things, a lot of our veterans, they go do 4 years. They use the GI Bill and go get college paid for, and then they go buy a house using this. So those two things are really beneficial to you. So why is this beneficial? 0 down, no mortgage insurance on the monthly basis. If you are not exempt, the biggest exemption is if you have a 10% or higher service connected disability, you're exempt from the funding fee. But if you have to pay the funding fee, your first time using the VA to buy a home with 0 down is 2.15%. So it's even higher than FHA, but they don't charge anything monthly. It's 2.15. It goes up front and it gets financed again. So you don't pay anything. 0 down, 0 monthly mortgage insurance. So again, a lower payment, lower interest rate than conventional, just like FHA and USDA benefit from. And then probably the last one that we want to go to, there's 2 pieces to it. Let's talk about credit first. Credit, they don't have a minimum credit score. Now, in reality, they're not just saying, hey, we don't care about your credit. There's guidelines that say, can you have had a late payment in the last 12 months, in the last 24 months? So we can do manual underwriting just like with an FHA. But in terms of flexibility, in terms of credit, VA is every bit as flexible in terms of FHA, and the credit score requirement is even looser. But the same thing in terms of getting good terms. 640, 620 is going to get you very good terms. Below that, you're going to start paying a premium. So those are the big ones there. Jeb, anything else that you can think of with the VA?
Well, I mean, VA, one thing that, I've been told by borrowers, and you can verify this, is that, if you have a service-related disability, like you said, you're not paying that upfront mortgage insurance premium, right? There's no mortgage insurance. Huge benefit there with VA, right? So putting 0 down for most veterans, not paying any mortgage insurance. If you have a service-related disability, which a lot of people do, you're not paying the upfront mortgage insurance premium. And here's the thing. States like Texas, at least my understanding, is that you don't pay property taxes in some of these states where you have a disability.
Jeb, we have a listener in Maryland that we're doing a cash out refinance for, which you can do to 100% with a VA loan. So he has a service-connected disability, 100% permanent in total, so he's not going to pay the funding fee, which can be like 3.3% on a cash-out refinance. He's getting that waived. And in Maryland, he has no property taxes, pays 0 property taxes. There's 4 or 5 states where you pay no property taxes as 100% disabled.
And that's pretty wild. And thing we didn't mention too is VA, FHA, both a lot easier to refinance with than a conventional loan. So if you're somebody that's looking at a rate now and thinking, hey, listen, if rates come down in a couple of months, I'm going to be able to refinance. FHA and VA are definitely the better of those, because you don't have to requalify with income. Appraisal isn't really a factor in that regard. So if values do come down at all, you're not limited in being able to refinance. So huge benefit with those. Important things to note. But again, VA.
The last one we didn't talk about, Jeb, we talked about it's going to have the lowest payment because of no monthly mortgage insurance. Of all these options, the lowest payment, it also has no debt to income ratio. They use something different. They use a residual income calculation.
We might have the max.
So a long way of saying, you and I think, did close the deal that I have the VA record, my personal VA record, and it was a 72% debt to income ratio. So if you meet the residual income requirements, by far and away, cheapest, most flexible, best option. But if you're not eligible because you didn't serve in the U.S. military, it doesn't matter.
No, it doesn't. But I think let's talk about that story, Josh, because people hear a 72%, 67%, whatever his debt to income ratio was. And they go, how could somebody qualify for a home and do that. And George owned that home for 3 to 4 years, if I remember correctly, gained about $100,000 in equity over that period of time, and never missed a payment, but he had somebody living with him that had income that wasn't factored into the calculation. So there was some additional income there. So his debt to income ratio looked high, but he had some compensating factors, or in this case, residual income that helped him. So,
yep, the residual income we squeaked by with just by the hair on our chin there. But what I will say is, whether it's an FHA with that max 57% debt to income, a VA with a 73% debt to income, people say, well, that's just a foreclosure waiting to happen. Most people are rational.
Are people?
They know
really?
something we don't. Most people are rational. They don't want to pay a 3.5% down payment, pay $10,000 in closing costs to lose a home 6 or 12 months later. So what I can say is, almost every time we have a very high debt to income ratio, there's something going on there. George had a girlfriend who made just as much money as he did. The household income was twice what we had. Now, George didn't keep that girlfriend. That's where the problem can come in. But there's that situation. A lot of times we'll have maybe a spouse that makes another $5,000 a month and has a 300 credit score, so they can't go on the loan. There's generally reasons why someone is comfortable with a high debt to income ratio, because those numbers are high.
All right. So with that said, Josh, what I would tell people listening, don't go at this alone. Don't try to figure this out. Listen to Jeb and Josh and think, hey, this is the loan program. Call a qualified mortgage professional like Josh, the team here. You can use that link in the description. Let him guide you through the process, ask the right questions, and ultimately you'll come away knowing, the right option for you, but you'll be making that decision. So with that said, if we could be of any assistance, make sure you check that out. If you're listening to this prior to December 9th, we're actually doing a first-time homebuyer seminar at theeducatedhomebuyer.com/workshop. That link is also in the description. Make sure you attend that. We'll take you through the whole entire home buying process from A to Z. You'll walk away knowing exactly what you need. And if you're listening to this after December 9th, if you still go to that link, it'll get you at least a playback or the new date of when we're going to host the next episode. So with that, we appreciate you taking the time to watch. If you found any value, make sure you hit the like, subscribe to the channel. See you next time. Adios.
Amigos.